So welcome back to the channel. My name is Brad, and today I have a special guest with me today from GraniteShares, and we're going to talk about their newer ETFs and some of their older ETFs that might be interesting for those income investors or those trying to get some yield. So I'm going to just let Will go ahead and introduce himself to everybody, and we'll talk about some of his funds.
Awesome. Well, Brad, thank you for having me on the channel. Great to be here.
You're welcome.
Everybody, I'm Will Rhind, founder and CEO of GraniteShares. We're an ETF issuer. That means we're an asset manager, a money manager that specializes in one particular type of fund, an ETF or exchange traded fund. We run a global business headquartered out of New York City, manage around $8 billion and a bunch of different strategies, from what you might call traditional ETFs to leveraged ETFs on single stocks and options-based income ETFs. We're very active in the European markets. We're listed on all the major European exchanges, and then also in Asia as well.
Interesting you brought up those markets, because I do have some Europeans that watch me. What exchanges are they actually on?
Yeah, so we have the UK London Stock Exchange, we have the Milan Stock Exchange, and then a few products in Germany as well, and Euronext.
Okay, very good. And they would be able to find out on a website?
Yeah, if you go to GraniteShares.com is a global website, so you just have to do sometimes it can be a bit annoying, but you have to navigate on the top right. There's a flag filter, and you sort of choose your flag according to where you are, which country you're based in. It does normally geolocate you, but you might have to sort of move through the flags if you're coming in from a country where we don't actually have listed products.
Great. I figured that out. I'll do a little screenshot in case the Germans want to see that and see what funds you have available for them. I do have a couple German members actually to the channel.
Cool.
Let's go ahead and talk about YSPY. That was what interested everybody or got this conversation started. Was they asked me what my conversation was on YSPY, and I went, it's a newer fund. And then you got, TQQY, which would be probably the same strategy, just on the Qs. So what can you tell us about those particular funds?
Yeah, so those are two that we just launched most recently. So they're a follow-up to TSYY, which was the first YieldBoost ETF that we launched. And YieldBoost is a new family of ETFs from GraniteShares. So it's options-based income ETF. So the designed to maximize yield, and they do that through an option strategy. But the unique selling point with YieldBoost is they generate the premium, which is the amount of cash that we earn when we sell options, from options on leveraged ETFs. And the reason we do that is because there's more implied volatility, and therefore there's more premium to be harvested. So TSYY was the first one. We paid the second distribution actually just at the end of last month, end of February. That was over 160% annualized yield. And then YSPY and TQQY, we just launched in the last week or so. And those are linked to obviously the NASDAQ 100 and the S&P 500 respectively, but leveraged ETFs on those.
And you're selling and buying a put with a more of a put spread.
That's exactly right. So it's a put spread strategy. So on the one hand, to generate the yield, we're selling a put, and we're selling the puts off of the underlying ETFs that generates that high yield. And because of there's such amount of yield or such amount of premium that's harvested, we can then afford to use some of that premium to buy a put on whatever the underlying asset is. And we do that because while the premium earned is significant, what these strategies don't do is insulate you from the downside particularly well. And so by buying a put, you're able to offer some protection against extreme movements on the downside.
It brings up an interesting conversation, because right now you're through your protective put. Now, would you have to pay out the earnings of that protective put, or do you get to keep that?
Yeah, so in terms of the strategy, when we buy a put, if it expires worthless, obviously that's it. But yes, the fund gets the proceeds from whatever the strategy is.
Okay, so the fund does, so you get to keep that premium, which helps the NAV, which
Correct.
right?
Yeah, that's why the NAV. If you look at TSYY, of course, I think I was saying to you before we went live, I think we literally launched on the day that Tesla top ticked. So
Yes.
you picked a worse time to launch. That being said, given that the price of Tesla has declined, I think every week officially since Musk has been in government or in Washington, the NAV hasn't declined by as much as you might think, at least when I last checked in terms of Tesla stock, and that's because of this strategy.
Okay, and just Tesla's up today for whatever reason. And I follow Tesla. It's just one of those funds, stocks that I follow. It's just not the best one to be in right now.
Yep.
Right.
Yep. High yields.
It gets that high yields, and that's what I'm trying to do, and what I try to preach to people is, hey, I can live off of 8%, and I can put that rest of that yield back into something. Right.
Yep.
And that would be the same thing for these type of funds. It's a high yield, meaning I can take my 8% and harvest 8% on my original investment and put that back into the fund, which is something that we'll just have to monitor over time. All right. Talking about that, any projections of what these may pay as a yield? I mean, I guess I could back test them, or better. Yeah, go ahead.
The yield yield's a really interesting subject in of itself, because yield, of course, is almost like a made-up concept, because it's only relative to the amount of cash that you pay versus the stock price at the time. Mm-hmm. So in terms of yield, it's always hard, especially when you have something that's volatile, the underlying that's volatile, to forecast a yield. So distribution wise or premium wise, maybe it's easy to think like that. And the reason why we chose the options on the leveraged ETFs is because they have roughly double or twice the premium, the implied volatility of options on individual indices or stocks. And that obviously goes without saying, given that the ETF could be 2 times lever or 3 times in some cases, what TQQ or the YSPY SPXL. So that's why you get the huge amount of premium from. So all things being equal, you should have a higher yield. But again, yield is just a function of the amount you pay versus the share price at the time.
And how are you doing the puts? Close to the money, out of the money? How's that spread actually thought about?
So we use weekly flex options. So flex options are a bespoke strategy that we trade with the specific broker partners that we have. So these are not options that anybody can just buy on a listed exchange. And we're typically trying to sell options that are at the money or close to at the money to generate the maximum amount of premium. And at the same time, buying a put option that is typically around one standard deviation out of the money. And that means that we get some protection for the strategy against those extreme down moves.
So in an upwards bull market, this would actually perform very well, if I'm thinking of this correctly.
Yeah, it tries to offer, if there is ever such a thing as the best of both worlds, it tries to offer the very high yields with some exposure to the upside and some protection against the downside, with the caveat being that there's no free lunch, nothing is perfect. And with clearly some of the moves that we've seen in Tesla, there's almost there's no amount of protection that we could have bought without sort of ruining the strategy that would have been able to fully insulate you from the downside.
Sure. And how about taxes on this? Since they're not 1256 contracts, how is taxes handled, or what do you suspect of ROC compared to capital gains, compared to ordinary dividends?
Yeah, I mean, typically with the options, again, as far as the strategies are concerned, if there's a gain, that will be, for holdings over a year, of course. But for the main, it's income, they're taxed as income. So when you get that distribution, just like the majority of either income-based funds and fixed income or options.
Sure. And compared to yourself, compared to other products in the market, Yield Max or one of those others, how do you see yourself in the future? Do you see yourself having higher yields than others or similar yields, just as a different strategy?
I think the main sort of comparison, at least when you talk about single stocks, so it would be yield max, and the idea was to generate more yield or certainly more premium through the strategy that we have, while being able to offer some protection to the downside and try and insulate people against the NAV decay that happens so frequently with a lot of the covered calls. The other thing I should mention, Brad, is that we are a put selling or put spread strategy, whereas majority of these other players, they're covered calls. Now, the payoff is identical, but it's executed differently. The reason why we chose to do the put selling strategy is that with single stocks in particular, you have to do a very convoluted execution to generate that synthetic. It's not a true covered call because that's actually not allowed from a regulatory perspective. So it's a synthetic position, and it's more complicated to do. And I think for us executing the put spread, simpler, cleaner, easier from a regulatory perspective, and hopefully easier to explain to people.
Sure, because to me it looks like a cash secured put spread compared to doing a synthetic, and then you have to roll the synthetics.
That's right.
And everything that comes along of generating a synthetic.
That's right.
So, and that gets into some of the other funds that are doing longer dated puts with 1256 contracts, which as a retail investor, mark to market was not something that was taught to me in high school. Right. I had to hear about that from somebody else other than, the fund managers coming out and just saying, hey, these are the rules that we have to play with. And that's what I'm trying to get across to the viewers is some of these rules are, I'm not a Act 1940 expert.
Right? Yes.
Yeah,
and that's right. They're simply immovable objects. And that's the regulation, that's the law. And those are the rules you have to play by, and you engineer a strategy accordingly.
That's right. So what I see with your strategy is fairly simple. It's, cash secure puts with a protective on the downside, about one deviation away that you explained, that should generate a very high yield. And then an up market, all right, you're not going through your puts, you're just collecting that yield, right? Which is, what everybody would like to see, right?
I hope so.
I hope so, right? And then let's go ahead and talk about what really interests me as an income investor is your HIPS product, if you don't mind. How does that actually work, and what's in its underlyings, and why did you come up with this?
Yeah, it's actually, this is a great segue. So we've been in the income space for a long time. So HIPS, the acronym stands for High Income Pass-Through Securities. And pass-through securities are probably something that most people don't know by name, but they'll know or be familiar with at least one of the types, the subcategories of pass-through securities. So pass-through securities are securities that don't pay corporation tax. In other words, they pass through substantially all of their income by law to the shareholders. And the four main categories of pass-through securities are MLPs, or master limited partnerships. These are typically entities that own energy infrastructure like oil and gas pipelines.
Mhm.
Then you have BDCs, or business development companies. These are entities that act almost as sort of quasi private equity, private credit vehicles, lending money to small, medium-sized businesses typically. You have closed-end funds, which are a type of fund, which in our case, they're mainly on the fixed income side, but can trade at premiums and discounts to NAV, which allow for yield in the cases of discounts. And then you have REITs, which most people will be familiar with, and REITs are everything to do with real estate. So you typically have two types of REITs. You have equity REITs, which buy physical property, whether it be commercial buildings, residential buildings, and then you have mortgage REITs, which hold the actual underlying mortgages themselves. But all of those together, they're all different types of pass-through security. And pass-through securities, as the name sort of perhaps dictates or implies, you automatically start with a higher level of yield or distribution because you're not paying corporate tax. There's no government in the middle, clipping that, 30%, whatever, off the top. So blended those together, it's an equally weighted portfolio. So you have 15 pass-through securities in each sector. And that's a portfolio that's equally weighted. And the real sort of differentiator about HIPS is it pays a fixed cash distribution. So it pays 10.75 cents per share every month. So it pays $1.29 or whatever of income per annum. And now we just come past the 10-year anniversary. So 10 years of making that distribution every month. And it's never failed distribution in 10 years. So there's probably a lot to unpack there, but really interesting strategy. It's not leveraged. It's just a traditional income fund. But the idea was to create a fund that paid a fixed distribution so that when people buy it, they lock into that yield at the time. So let's say, for argument's sake, at the moment, it's 10% per annum roughly, that if people buy it, they're locking into 10%. If the underlying price goes down a little bit and the yield goes up, or if the yield goes up and the underlying price goes down, then people are buying into it at different stages. But that's sort of really the value proposition behind it.
Yeah, and I brought it up on a chart on my other screen here. It looks like the price has been very stable or slightly increasing since 2003, and you got an okay total returns reinvested. But as somebody that has to live off of this, that is
Yep.
what I'm personally looking for. I'm okay with putting 2% back in, all right, but
Yep.
taking my 8%, and I personally don't have a master limited partnerships in my portfolio. K1s, or is this a 1099?
So this is why we keep the level of MLPs below a threshold amount. And so it's an equally weighted portfolio. It's designed so that we do not distribute a K1 to investors. It's pure 1099. We handle all the taxes within the fund. The investor is just a regular 1099 investor.
The first thing that somebody's going to look at your fact sheet, they're going to ask me, someone just asked you, total annual fund operating expenses. Can you describe that to people?
Yeah, so this is the thing that we have to explain the most, this is the least understood part of an investment in this strategy. So as you'll see from the total expense ratio, the management fee that we charge is 70 basis points, or 0.7%, which is very much market with these types of funds. But you'll see an expense ratio of a hair under 2% at the moment. Now, people will be saying, wow, okay, 2%, for an ETF, goodness me, I can't buy that because ETFs are supposed to be cheap, aren't they? And the reason for that is almost entirely down to the fact we own BDCs. So within the context of an ETF, BDCs are unique beasts in the fact that they're taxed like mutual funds, not like corporations. So BDCs are actually, by law, taxed as registered investment companies, which is a kind of another way of saying like mutual funds. And for that reason, they have to show or declare all of their expenses and compute that in a total expense ratio. So think of it as being like if you bought a share of Apple, you just buy the stock price. You don't think about the expenses of the company being a percentage of what you buy, and therefore think of it as being charged an expense ratio. And that's unique, or that's the case with BDCs. The actual reality is you pay the stock price just like everything else. The expenses for the management, everything else is reflected in that stock price. It's just declared differently. And here's a small sort of fact, which is interesting. So because of this is such an anomaly, there's a lobby group that's trying to get this changed. And the reason is because they think that it sort of unfairly impacts BDC's ability to raise capital. And specifically when it comes to broad indices. So if you look at a lot of broad market indices, you may know that they, or may note that they do not include BDCs in there, even though there are some BDCs that have significant market cap. And the reason is because they would then have to declare an expense ratio a lot higher than the management fee, which for the uneducated investor might put them off buying. But if you look at the performance of the ETF against the underlying index, you'll note that, surprise, surprise, the tracking error of the fund is around the same as the management fee. In other words, 70 basis points. So you're not paying 2%, to own the fund. It's just the way that you declare. There's a pure play BDC ETF in the market that is another good fact sort of checking point here. And that's for another company, not us. It's another company called Van Eck, and the ticker code is BIZD or BIZD. And if you look at that,
I will put their link down below to their description on business development companies and why that's so high.
That one I think is total expense ratio is around 10%.
Yes.
So clearly, no one could buy a fund with a 10% expense ratio. It's just unfortunate the way that the tax and the regulatory regime is set up for BDCs. But anybody that knows BDCs, that's familiar with BDCs, understands this. It's not an issue. It's just that for people that use expense ratio screeners, etc., a lot of the times they'll just screen out a high expense ratio fund, which puts them outside of the scope for BDCs.
That's correct. And BIZD is one that I hold and one that I talk about. Yeah, same thing with PBDC, right? Another one I hold. I split it between the two.
That's right.
And I'm just looking at your holdings. You have Trinity, which is, how do you pick your business development companies? Is going to be my first conversation.
Yeah, so this one actually is an index. So the index that we follow, really we're looking for two things. So given it's an income product or a yield product, we're clearly screening for yield. So we try and pick business development companies or any pass-through security with a high yield. But the kicker is that we don't want securities that just have a high yield. We also have a volatility screen. So we screen for both a high yield and low volatility. And then the best securities above a certain market cap in that sector become the stocks that are included in the index and therefore the portfolio.
Yeah, I'm just looking at this real quick. How do you pick your master limited partnerships? In the same way?
Same way. So it's all the same securities. So we start off with the universe. I think for the pass-through universe is, $1 trillion plus worth of market cap, 400 plus securities. And so you then start to filter down from there. So you filter by sector, looking for securities that have the highest yield but the lowest volatility. And then above a certain market cap, which is a liquidity screen basically. And then those become your portfolio. We rebalance or reconstitute once a year.
And you're paying monthly distributions about 10%. That's very nice.
That's right. It's 10, but the kicker is it's actually a fixed cash distribution, which is pretty unique in the fund world. So we pay that 10.75 cents per share, which means that if you buy the stock today or 6 months time or 6 years time, that you lock in that yield at the time because that's your cost basis. You're getting paid the 10.75 cents per share on the amount that you invested at the time. So you're locking in that yield.
Okay, nice. And one thing I don't hold a whole lot of is REITs, and you're doing the same type of screening on REITs, and you also MREITs also, or?
Yep.
Okay.
It depends. Obviously, you can see the beauty of ETFs is they're 100% transparent. So you can go on GraniteShares.com, go to HIPS or any of our product pages, and when you scroll down to about roughly the middle of the page, there'll be an option in data or one of the tabs where you can download the portfolio. So you can download the portfolio into a spreadsheet every day and see exactly what we're holding. And that will give you the portfolio of REITs, of MLPs, of closed ends, and BDCs.
That's correct. I'm actually looking at it. I did that while we were on this, right? I see the business development companies jumped out at me. Hess jumped at HESM. Hess Midstream jumped out at me. That was one that I was always interested in.
Yep.
Right. And then Trinity Capital, which is something I was interested in.
And I think what we try to do is the idea behind HIPS is it's an all-weather income portfolio. So the reason why you blend those together as opposed to just having, say, pure BDC fund is that it eliminates the need for people to pick between one sector or the other. So whether people, want to decide whether MLPs are going to outperform BDCs or REITs are going to outperform closed ends. And the idea, therefore, is, we're always trying to pay that 10.75 cents per share per month. So by being in a product like HIPS, you're not going to be the absolute top in terms of yield or outright performance, but you're not going to be the bottom either. So you're going to be around about that middle and be able to then make those consistent distributions so that irrespective of the market environment, whether we're in a high growth environment, a low growth environment, a high inflation environment or low inflation environment, there'll be something in the portfolio that will be performing and able to generate yield. And we saw that clearly with 10 years worth of track record through all sorts of market cycles, including probably the worst ever income cycle, which was in COVID.
That's right. You had that big dip in COVID, and then, but so did CLOs and everything else took a big dip in that credit market.
Yeah. But the crazy part with that was that the fund would perform exactly as you might think. In other words, the NAV, went down significantly in that time, but crucial to the investors in HIPS, none of the stocks bar one stopped paying their distribution. So we had one, which was a hotel REIT. And the hotel REITs, obviously hotels closed down, and therefore that particular REIT stopped paying distributions. But everything else maintained payments, and therefore the fund was able to make its 10.75 cents per share per month and during probably the worst period of time for income, where tons of stocks were stopping their dividend payments or cutting dividend payments. As funds were cutting dividends, were stopping dividends. So very interesting time.
Since it's a 1099, is it return of capital? Is it?
Yeah.
How's that actually divvied out? At least last year's. I know it's not consistent every year.
So there's a combination of course, on the income component of income and return on capital. So the good thing about HIPS is it's not just all income that obviously equates to income tax. You do get a decent percentage of that that's return on capital. Now, here's a really important thing to say is that there's sort of two types of return on capital. There's what we might call bad return on capital and good return on capital. Bad return on capital is when a fund sells assets to help sort of prop up a particular yield or distribution, and therefore is literally just returning your money back to you in the form of a distribution. That's a bad return on capital. A good return on capital is where you're investing in certain asset classes. And in the case of HIPS, it's mainly from MLPs, if not exclusively from MLPs. But part of the tax benefit that MLPs enjoy is that a portion of the income that's generated from an MLP is return of capital. So the actual income stream that you're getting, and therefore the fund is just passing that income stream back to the investor, is a return on capital. And when you get a return on capital, that's affecting your cost basis. So you're driving your cost base lower for when you sell it effectively at a capital gains, hopefully if you hold it for more than a year, rate sometime in the future. So it's a way to be more tax efficient. And therefore, out of every dollar of distribution you get, I think historically it's been around about 40% of that. You can see on the website.
We can go look at
capital. So it is a benefit for investors that are, again, in it for the long run. Of course, doesn't apply if you're in a tax protected plan of some variety, but for just regular ordinary income investors, something definitely to bear in mind.
Yeah, and it keeps you from having to pick your own funds, and that's
right, or the individual stocks.
That's correct. That's correct. Any other type of income funds like HIPS that you're planning?
That was why we started to think about, we wanted, first of all, to use HIPS as a bit of a beachhead for our income strategies. And then we decided to think about potentially options based on HIPS, but a lot of these securities don't have options. So that's what led us into the YieldBoost family to then think about, well, how can we create options-based income strategies? And how can we do that in a way that's unique in the market that's not been done before? And so that's really what led us to the creation of YieldBoost, which is a 20 ETF family, of which we've launched the first 3. But we started on that journey from HIPS and the lessons that we learned in creating income through that.
Getting back to YieldBoost, what are the other? Are they all single stocks after this?
No, so it's a mixture of single stocks and diversified indices and things like Bitcoin. So again, think about the proposition behind YieldBoost is, maximizing yield. So we're going to be looking at underlyings that have very high implied volatility and high potential to pay out high premiums. And so those are naturally going to be those instances where you have the indices, certain sectors like semiconductors, for example, and then of course the individual names like Tesla, Nvidia, etc.
Sure.
I think the other things is the rollout. I mean, we've got the funds are all effective, which means that we can roll them out, and we will continue to do so. But I think with YieldBoost, it's really just getting that conversation started, getting that awareness in the market so that people can look at the distributions. We've had really just the 2 distributions from TSYY. So people are certainly looking forward to distributions from YSPY and TQQY. And of course, we'll start rolling out the family, as we go along.
Sure. And so you're collecting premiums every week, but paying out on a monthly basis. Is that 4 weeks behind, 5 weeks behind, and you're just paying out the 4 weeks, and then you got a week or 2 of administrative work to calculate?
Yeah, I mean, it's something I guess maybe inferred in your question is that it's something we're looking at in terms of potentially doing a weekly payout. We're definitely getting some feedback that some people seem to like that. So it's something that we're thinking about. But at the moment, yes, it's a monthly distribution.
If you're in these funds, you're looking for those premiums and you're looking for yield, what are you doing with those yields? Are you reinvesting those yields? And that's a question that's been asked to other fund managers. Do you have to reinvest X amount of the yield to maintain your investment? And that's been his answer. And I'll go ahead and, after watching many of his interviews, he said yes. So, yeah. I don't see that necessarily being your funds, right? But he said yes,
Yeah.
that you have to do something. You have to put something back in.
Yeah.
So,
I think it depends on what you're trying to do. I mean, I think we started with this idea going back to HIPS for a second because it's a fixed cash distribution, but this idea that what's the value of fixed monthly cash flows? And if you think about an annuity in the retirement world, what is an annuity other than you give up 100% of your principal day one for a set of cash flows that are promised by an insurance company or another financial institution. So could you achieve the same thing by using a fund like HIPS, where you're not giving up your principal on day one, you keep your principal, you get a monthly cash flow, and that principal, the value of that principal may change over time. In other words, is exposed to the market, so it can go up or down over time. But at the end, you still have something as opposed to nothing. And I think that the concept around YieldBoost is just a more extreme version of that, where it's not a fixed monthly payout. Of course, the payout's based upon the yield, but I think that there's fundamentally with any long-term investment strategy, it's always a combination of capital growth and income. And increasingly, we're seeing people sort of polarized around this idea of putting some very high income or high yield elements into the portfolio and complementing that with maybe much more conservative elements around capital growth or protection. And that's sort of, I think, what we're seeing more and more of as people move away from some of the traditional sources like bonds, where they've been burnt over the last few years with rising interest rates.
that's right. So that's interesting that you brought up thinking of it of like a annuity. I have Stephen from the Income Factory behind me, and he thinks of things of nobody cares what the cost of the plant is, just how much is the plant producing.
Yep.
Right. And there's some truth to that. I mean, the bean counters care about the plant, but other people, the factory workers or others, see it as how do you generate that income. And so if you're treating something like this as an annuity, all right, so what if it goes to zero over time? My only comment is as the NAV goes down, except for HIPS, as you described, right, your premiums would go down. Is thereabouts.
Well, yeah, I mean, it depends on the sort of the size of the fund and the applied volatility of whatever the option is at that time. But I think the concept is still valid. In other words, you're talking about what's the value of a steady stream of cash flows. Now, HIPS is a different construct, but again, this idea that if I was to tell you, for example, let's just hypothetically say HIPS is 10% right now per annum. So if I was to tell you what's the value of locking in to 10% per annum, well, you might say that there's a huge value in that because that's a budgetary thing, that's a lifestyle thing, that's a sleep at night thing, where you don't have to be watching the portfolio on a daily basis. And yes, the NAV will go up and down because it's exposed to the market. But at the end of the day, it's for people who are prioritizing income. And I think that's sometimes what's missed in a lot of these income conversations is that people sort of always look, but what about the capital growth? And well, okay, if you really want capital growth, you shouldn't be buying an income product. If you really want capital growth, there's plenty of products that do capital growth. They don't pay out income. It's a different thing. But to try and combine the two, typically that involves two separate investments, not the same investment.
That's for me personally. I had IBV and QQQM until yesterday. Right, that's my growth side. Right, my income side is income.
That's right.
Right, and I look at as yield on cost, or how much I'm putting in $100,000, right? And I want 8% on that $100,000. I want $8,000 a year.
Yep.
Right. And here you have HIPS. I put in $100,000. I should get $10,000 out of it every year perpetually.
Yep.
Is what I'm hearing. Right.
That's right. That's the goal.
And then you have an annuity. And let's say you get an annuity for 6-7% if you're lucky. Here you have another product that at least at the end, NAV go up, NAV go down, there's still something to pass on to others.
That's right. Or to sell and do whatever you want with it.
That's right.
You have the option. You're in control. You lose control when you sell your principal to an insurance company.
And if you take a yield boost on that same philosophy, you can have the same philosophy. You just need less capital to get there.
That's right. And again, the yield boost is clearly more risky. So I'm not trying to say that they're the same thing or suggest they're the same thing, because the moment you see a yield of 160% annualized, it's clearly way more risky than something with a yield of 10%, all things being equal. But it's the role in your portfolio for putting complementary assets together that where you may be able to take a bit of risk on the yield side, generate some spectacular yields, but combining it with lower risk parts of the portfolio that don't provide the same level of volatility.
Yeah, like treasuries. I mean, I'm looking
or
at
cash or money market funds.
I'm looking at that personally myself. Is I'm looking at, I have a high yield bond. I have a fund from Neos on REITs. All right. I'm looking at their short-term treasury. If Warren Buffett tells me that I should put 10% when his wife, or when he passes away, it goes into an index, and put 10% into treasuries, you said they're going, why does he say 10% into short-term treasuries? All right. And we're seeing that today with the market. Is I kind of wish I had 10% sitting into short-term treasuries.
Yep.
Right? Or some percentage sitting into short-term. Do you know what the beta is for HIPS? Or do I have to? I'll look that up.
Right? You can do, but the beta is always a function clearly of the time period. But again, HIPS is more correlated to the market, the stock market. I mean, so I think it's roughly let's say a high 7.7 to the market. But the interesting thing is it has a zero correlation, or it's not correlated to fixed income. So again, that's a very interesting complement for income investors, not necessarily for stock investors, because again, it's not a growth portfolio. But for income investors, that's very valuable because you don't double down on duration risk by accepting a higher yield.
And I'll run that through. I do look at correlation. I have some items that are negatively correlated to others.
Yep.
Right. I mean, that's
gold.
I've done well here recently that I'm not all into equities.
Yeah.
Right.
Yeah. So whenever you got stocks, I mean, even though the pass-through securities, they're not, corporations, they're still equity-like because they're listed on the stock market. You still buy and sell them just like regular stocks. So they're going to trade and behave more like stocks that as opposed to bonds. Yeah.
So let's take your one based on Tesla, or let's take one SPY, either one. All right.
Yeah.
So you would put a certain percentage maybe into a SPY, and then that way you have full market participation. And here you're generating a high yield. Any thoughts of what percentages, or have you ran those numbers?
I mean, that's such a difficult one because it's not just about the portfolio level correlation. It's about what people's investment objective is and their tolerance for risk. So for one person, it could be a very meaningful allocation. For another person, it could be not. Just like It's just a question of what you're trying to achieve. And I think the role for something in this environment, which has prioritizing income over capital growth, is actually a very interesting concept. And that's why there's a lot of people getting into these particular types of funds, because it's an interesting idea in an environment where we're perhaps less certain about the direction of the market over the next sort of couple of years. If you're laser focused on the direction of the market and you're super bullish and just think that the price of Tesla is going to go to the moon, then an income-based product on Tesla is not the right thing for you. Then clearly you should be buying Tesla stock. Or if you're very, very bullish, maybe think about a levered Tesla ETF. But it's not an income-based. So I always think about these funds in some level. I'm talking about the YieldBoost is a little bit like the role of an insurance company. So effectively, what are we doing? We're selling insurance. We sell insurance, we can say car insurance, and we get a premium for that. And think about it as the riskier insurance, the more premium that we collect from drivers. Now, the game is clearly to collect as much premium as you can without incurring any losses. And that's your gain on the product. Now, what you hope is that everybody doesn't crash their car on the same day, and therefore the losses outweigh the premiums that you received. But there's also an element in there where some people will have accidents, they will put in claims, but you hope that that's not going to be larger than the amount of premium that you've already received. So that's the game with the income products, is to generate as much yield as you can while protecting against the downside, or as much as the downside as you can. But it's not capital growth. And I think that's just an important, maybe it's obvious, but sometimes I sort of hear people perhaps mixing the two.
And they do. They mix it all the time. I mean, I'm dealing with a lot of the public, and I see that income is income, growth is growth, and how does one affect the other? I mean, you could have put it all into an annuity and lost all your capital, but you would be able to sleep at night because you know what you were getting next month.
Yeah, it's the tool for it's the tool in the toolkit analogy. Like some tools are for certain jobs, other tools are for others. And there are some tools that are more like, or more sort of versatile than others, but clearly you got to pick the right tool for the right job.
Anything else? I mean, that's great for the income investors. I mean, that's just a lot of people just get focused on growth and they're younger, but there's a lot my age coming up to, believe it or not, I am 57. I think my wife told me I was 57. So I got to retire early.
Yep.
And knowing that I'm retired early, there's certain risk in my life that I have to worry about health insurance and everything else. So
and costs are going up, not down.
That's correct. Any thoughts about non-political of the current market conditions?
Well, I think what we're seeing is clearly an attempt by the market to digest what can only be seen as bad news in the short term. Now, that's not me saying the short term, it's just that's the way that the market's taking it, almost from a day-to-day perspective, as more news filters in about tariffs on certain countries, certain sectors, retaliatory tariffs, trade policy just more broadly. And I think also part of it is this idea that we've got to sort of detox a little bit from the spending like drunken sailor type environment that we've been in for a number of years, and running massive deficits, which are clearly not sustainable in the long run. So it's a combination of those factors. Chickens have come home to roost a little bit. I think, as sort of non-political as I can be, I believe that just like tariffs 1.0, that there was a sort of a medium ground that was found, and everything stabilized, at least going back 8 years ago. I'd like to believe that that's a similar thing now, and this is a buying opportunity in terms of the disruption that it's causing, And clearly, if you look at some of the major stocks or whatever your favorite sort of asset is, it's not a fundamentally driven move by any means. It's purely a macro trade growth sort of issue. So all that being said, it's certainly a disappointing start to the year, considering where we sort of ended last year. But hopefully we're setting the table for another sort of growth spurt, almost similar. If you look at you may have seen some charts doing the rounds on the internet of the S&P 500 charted against the S&P, obviously rebased for the Trump 1.0 versus the Trump 2.0, and it's tracking almost exactly so far. So if history's any sort of guide to where we're going, then hopefully things start to stabilize and go on another growth spurt, which we'll see markets, assets, and then we do well.
Any opinion about cryptocurrencies?
Not really. I mean, I personally am not invested in it, and I guess that's not really sort of from a philosophical perspective. I think I've always struggled with the fact that it's an asset with zero intrinsic value, and this sort of intellectual question at some point of once you decide that something with no intrinsic value is worth more than nothing, it can be worth anything. So I've sort of always fundamentally struggled with that. The idea that, once you make up your mind, it's worth something more than zero, then it can be anything. So is $78,000 a buying opportunity? Is 100,000? Is a million? Who knows?
Who knows?
The way,
and I look at it as what. I'll edit this one out if it doesn't come out good. I mean, who says gold is worth anything? It's a rock.
That's right. Yeah, somebody, I've selfishly, been involved in gold for a long time. I used to run the largest gold fund in the world, and I echo part of that sentiment. The reality, though, with gold is it's difficult for people to make that exact analogy, because to get gold, you have to actually take the stuff out of the ground, which is a very expensive process. And regardless of what you think about the end value, there is significant value, energy, resources, etc., that are deployed to get that metal out of the ground. So your starting point has to be that in order for that process to be worth anything, what you're bringing out of the ground has to be worth something. In other words, it has to be worth more than zero. And then that's just the start of a very, very long argument.
That goes right. We're going right down the path here, right? Because I can say, well, we're spending all this money on energy for Bitcoin, right?
There you go.
As I had to turn my Bitcoin miners off for the interview, right? Yep. So, I mean, that's a longer term. Any asset classes that you're in the markets. Any asset classes or things that are coming up with the ETFs? I mean, I wish I could have gone to Vegas, and actually meet you. Unfortunately, that's the week that I'm actually moving. Anything new coming out with ETFs, not just yours, but the ETF world?
I think in the ETF world, I mean, broadly speaking, there are let's call it three big trends at the moment. I think the first trend is clearly growth, anything growth, and particularly I think involving AI and future technology trends. So that's in part being reflected in just what you see in the market in terms of attention towards the Mag 7 stocks. But AI certainly big focus. The other one is options-based income. So the idea of replacing traditional fixed income with options-based income strategies. And then I think the other things are, let's call them more topical themes based around what's going on economically. So that could be, for example, the new Trump administration themes du jour could be more nationalist type trade policies, America first, infrastructure, domestic manufacturing, reshoring, that sort of stuff. But things that are topical for whatever the current economic and political environment.
And since this is more of a personal question, since you ran the largest gold ETF in the world, how do you think gold is valued today, since we've seen a big run compared to historical norms?
Well, I'll maybe answer that by sort of answer it in a slightly different way, which implied in that is sort of, why is the price so high? Because valuation is very relative. You can make the argument that gold's incredibly expensive today, and it's difficult to argue with that. You can also make the argument that gold is incredibly cheap today, given other factors which I'm about to talk about. And again, it just depends on your perspective. But I think perhaps the more pertinent question is, why is gold so high? And what is gold telling us that perhaps the market is not? Now, one thing that is important to know is that gold really acts as almost like a canary in the coal mine in terms of what is going on, macro-wise in the world. And gold is correlated to the M2 money supply as one particular measure. And what's happening is perhaps contrary to popular belief, the money supply keeps increasing. And so that's a combination of debt and liquidity at a global level, which means that the value of something like gold increases on a relative basis, because as paper money increases in supply and therefore decreases in value, it increases the value of tangible assets such as gold, which by the definition are a store of value, because the supply of gold can only increase by mine supply, which is fairly static every year, about 3% on average. So that's probably the first thing to say in terms of gold is really tracking that increase in global debt and liquidity, which is happening. The second thing is that gold acts like money, or behaves more like a currency than a commodity. So the other thing that's happening is that there's a rise in uncertainty. And I think that gold really performs best. In other words, the demand for gold is highest when there's fear. And fear motivates people more than any other emotion. And so when you have a high level of fear, and we're not there yet, but we're getting to an elevated level where people are starting to think about risk in portfolios, allocating away from some of the riskier parts that have been the trades of the last couple of years in gold. But if you look at panics, back into 2008, 2020, periods when gold went to an all-time high or shortly thereafter, it's the motivation that drives everybody. It's the fear of losing your capital, the return of your capital, rather than the return on capital. And so I think that while we're not there yet, clearly there's an uncertainty premium, which is baked into the price of gold at the moment.
How does gold reflect the Dixie? So that my conversation or my question is around, as the dollar's strength gets stronger in the world, other countries are using an instrument like gold to protect themselves against a strong dollar. Am I reading that wrong, or?
It's a bit of an anomaly, because really the strongest relationship that gold has or has had throughout history is almost as an antidote or a anti-colorant to the dollar. So typically that's a very strong relationship. Dollar's stronger, gold's weaker. Gold's stronger, the dollar's weaker. And the reason why this time is different is because it's not just the dollar that's influencing gold prices. In many ways, the bigger influencing factors are the rising levels of debt and liquidity and uncertainty that sort of almost trumps the dollar impact. Where you see particularly foreign countries buying gold in huge amounts is in a slightly different framing of the same question, which is why are they selling dollars and buying gold? Well, they're selling dollars not necessarily because they think the value of the dollar is going to go down. It's more that these are current countries typically that are amassing huge foreign exchange reserves. Typically, they're exporting countries. So they sell whatever exports, they generate dollars for those exports. Could be energy, it could be manufactured goods. And just like a normal investor, they're accruing large amounts of foreign currency reserves, of which they want to diversify some of those reserves. And so they're literally selling not just dollars, but they're also accruing reserves in euros or other currencies. They're selling those currencies, portion of the paper currencies, and buying gold. And that's a trend that's been going on now for more than 10 years, and will continue, I think, as long as this idea of diversification and having a store of value such as gold holds.
Paper gold to real gold. There's always been speculation that there's more paper gold available than real gold available. True, not true? Personal thoughts?
I mean, if you're sort of implying or directly saying that there are more derivative contracts, for example, linked to the price of gold than actual ounces of gold, then that's unequivocally true. It's just that's the way it's almost like fractional reserve banking. That's the way that the system works. So yes, that's completely true. That's by design. The question or concern, for the question to ask anybody who's concerned about that is, if you own gold, make sure that you own what's called allocated gold, which means that your gold is unencumbered. In other words, it's in your possession, or whatever entity you've used to buy the gold's possession, i.e. you own the title to it. It's not leased or lent out to anybody else. So if we have a gold ETF, BAR, B-A-R is the ticker, and that gold ETF holds physical bars of gold. We are not allowed to lend that gold out into the market. So that gold is an allocated form, and there's no credit or counterparty risk to that. So for people that are concerned about that, that's a really important fact, because there's a lot of product out there. You can buy gold futures, etc., that they're just representing the gold price, or they're a derivative of the gold price, but they don't actually mean your investment is backed by gold, at least not 100%.
Good. That's exactly where I was going, and that's correct. The derivative market is different than actually having, like yours, bar that holds gold that's actually unencumbered, as you put it. I mean, there's actually a one-for-one relationship between what you own and how much actually is there. Very
exactly.
Nice. Very nice. Nice terms. Anything else that you want to talk about, Will?
I think we covered a lot. It's been a great conversation.